Welcome to the Money Tree Investing Podcast. Stock market, wealth, personal finance, value stocks. Invest in your life.
Hello, Smart Money Tree Podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I will be your host. So today we have a returning guest. We have Richard Duncan. How are you doing today, Richard?
Great. Thanks, Kirk, for having me back on.
Well, glad to have you on again, Richard. I loved our prior interview, and I think this is a very timely interview again. I know you just came out with a new book, The Money Revolution, How to Finance the Next American Century. I think it's a great book, but I wanted to bring you on because there's a lot of topics that we had touched on before that are now kind of coming into play in a very significant way. And I think for a lot of people, they don't fully understand what's going on. Given the big changes in the economy and with money in general, I think it's really important that people understand the background so they can prepare themselves. So, Richard, in case somebody hasn't listened to the prior interview, which I will link to in the show notes, tell us a little bit about your background.
I'm an American. I was born in Kentucky, went to Vanderbilt. And after Vanderbilt, I had the great good fortune of backpacking around the world for a year. And I saw Asia in early 1984, and it was booming. I realized it was the land of opportunity. So after a couple of years back in the US at Babson College for my MBA, I went to Hong Kong and found a job as a securities analyst. And I've spent most of my career living and working in Asia since then, with a couple of stops in Washington. I worked for the World Bank there for a couple of years. And I was in London for a couple of years as the global head of investment strategy for ABN AMRO Asset Management. And along the way, I have written 4 books. The first one was The Dollar Crisis 19 years ago. And the new one that you just mentioned, The Money Revolution, has just come out in the last month or so. And I now have a business called Macro Watch, which is a video newsletter that I started 8 years ago.
One thing I wanted to talk to you about, because your book is certainly very detailed and it lists a number of the problems. I wanted to talk about some of the problems that we face now. You put a lot of content in there, especially about the history, but let's talk about what the problems we face are now.
The problems we face now, at the core, the main issue is that our economy has become addicted to credit. It needs credit growth to stay out of recession or depression. Since 1952, every time credit adjusted for inflation grows by less than 2%, then the US economy has gone into a recession. And the recession doesn't end until there's another big surge of credit growth. So we need credit to keep growing by at least 2% a year, adjusted for inflation. So in other words, if the inflation rate is, say, 4%, we need credit to grow by 6% to stay out of recession. And if it doesn't, then we have a recession. And if credit actually contracts, then we are at risk of having a depression. So our economy has grown dependent on credit growth. And in recent years, since 2008, that crisis, credit started to contract because the private sector couldn't afford to keep paying interest payments on all of its debt. Households started defaulting, credit started to contract. We came close to having a Great Depression, but the government intervened very aggressively with trillion-dollar budget deficits, and they borrowed the money, and that got credit growth growing again. But just enough to stay above the 2% level, not enough to generate a lot of economic growth. And so the Fed stepped in then with quantitative easing, pumping a lot of newly created money into the economy, cut interest rates to 0%. This was back in 2008, 2009, in the years immediately afterwards. And they started driving up asset prices on purpose to act as a supplement to credit growth, which was too weak to generate sufficient economic growth. So the Fed drove up asset prices, the stock market, the property market, through extremely low interest rates and round after round of money creation through quantitative easing, until we reach the point now where the net worth of the household sector, in other words, all the wealth of the Americans, all their assets minus all their debt, now equals $150 trillion. It went up by $19 trillion last year alone. And it's more than double where it was before the crisis of 2008. So they have created this extraordinary wealth by having extremely low interest rates and paper money creation. Well, so now we've gotten to the point, However, where there's a very big new snag in all of this, and it's the high rates of inflation that we're experiencing now. And so the Fed is going to have to start tightening monetary policy by hiking interest rates. And they will also soon announce that they intend to start reversing quantitative easing. Quantitative easing is where the Fed creates money and pumps it into the economy by buying financial assets. What they will do soon is the opposite of that, quantitative tightening, where they actually withdraw money out of the financial markets, removing liquidity. And so if this wealth has been created and has helped drive the economy higher because interest rates came down and down and down, and a lot of new paper money was created. Well, if we're now in a situation where the Fed's going to have to do the opposite of that, hike interest rates and have quantitative tightening, the asset prices are likely to start falling. The stock market, property prices, and all the other especially risky asset classes. And if that will destroy wealth, and if wealth is destroyed, and also the higher interest rates will make it more difficult for credit to expand by at least 2%. So that increases the odds. Credit will grow by less than 2% adjusted for inflation. So that suggests the economy will go into recession. At the same time, the higher interest rates are likely to cause wealth to contract, and that will be a negative wealth effect that also adds to the downward pressure on the economy, making the recession potentially worse. And all of this is compounded by the fact that asset prices have never been more inflated today relative to income than they currently are. One ratio that I look at called the wealth to income ratio. What it is the net worth of all the Americans, $150 trillion, I mentioned before, divided by disposable personal income. So it's wealth divided by income. This ratio has averaged 550% going back to 1950. But currently, in the NASDAQ bubble, it went up to 620%, significantly above average. And then the NASDAQ bubble popped and it went back to its average. Then during the property bubble in 2006 and 7, it went up to 670%. And then that bubble popped and it went back to its average of 550. Now it's completely off the charts. It's 825%. That's nearly 25% above its previous peak. And so what that means is asset prices are extremely inflated relative to income. And every time that's happened before, there has been a big crash in asset prices. So we're at a moment now with the Fed beginning to tighten and with asset prices particularly stretched, we could be in for significant destruction of wealth through falling stock prices and falling property prices. Now, not necessarily tomorrow or even the next quarter, but over the next year to 18 months as the Fed tightens. These are the big problems that we are having to confront now, the things that we must worry about, some of the things we have to worry about now.
You mentioned one thing in early 2000s when a lot of this started, a lot of these problems started. You said there was low credit growth. Why was there low credit growth in the early 2000s?
The credit growth was strong up between 2000 and 2008. In fact, it was booming. Household sector debt for about 5 years, the households were increasing their debt by $1 trillion a year. That was much, much higher than it had ever been. But they got to the point in 2008 where they were just so heavily indebted, they started defaulting. And that was the cause of the crisis of 2008. Well, afterwards, credit growth was weak after 2008, in 2009, 2010, simply because there was a severe recession initially, and also because of the very high debt burden of the households and the corporations. So they couldn't afford to borrow more. Had it not been for government borrowing, credit would have contracted and the US and global economy would have spiraled into a Great Depression like it did in the 1930s.
And that's been happening since, right? Has that changed much in the last 14 years?
So gradually, the government borrowed less. At the peak in 2009, the budget deficit was 1.4 trillion. I think it got down at the end of the Obama years down to 600 billion or 500 billion. That's the budget deficit. Then it started expanding again. By the time the COVID crisis started, the budget deficit was already back to $1 trillion a year. And then with COVID, government borrowing exploded once again. And in 2020, the government borrowed nearly $5 trillion in that 1 year alone. The highest before that in any 1 year had been just about $1.5 trillion. The COVID crisis was the next big crisis, of course, and the government once again followed the playbook that it had in 2008, very large budget deficits financed with paper money creation by the Fed. So between the end of 2019 and today, government debt increased by roughly $7 trillion, and the Fed created roughly $5 trillion. $5 trillion was enough to finance roughly 70% of the government's borrowing. So the government borrowed the money, and the Fed created money and bought the government bonds, the equivalent of 70% of the new government bonds. And that enabled the government to borrow and to spend and send out stimulus checks to the Americans so that they could continue to pay their mortgage and buy food. And that kept us from collapsing into a new depression during the COVID lockdowns. It also allowed the government to borrow this money at very low interest rates. Because, of course, if the Fed is buying 70% of all the bonds that the government is selling, then that pushes up bond prices and that pushes down bond yields. And that kept interest rates at extremely low levels. For a long time, the 10-year government bond yield was well below 1%.
I hear a lot about how, I guess it's probably about every 8 years or so, how the outstanding debt tends to double, especially during COVID. You know, the outstanding debt is significantly higher. Everyone's worried about that. What are really the problems with that, if any, with the fact that we have, what's the amount of outstanding government debt that we have right now?
The gross debt, all the government's debt, it is now $30 trillion. But if you look at the debt held by the public, in other words, don't count the debt that the government owns. The government actually owns some of its own debt in the Social Security funds and government pension funds. The debt held by the public is about $24 trillion, but the total debt's $30 trillion.
So what are some of the problems with that? Why is that a problem? Or is it? It seems like they keep borrowing and borrowing and borrowing, and the economy just keeps chugging along. So what are some of the problems with that?
The classical economic textbooks will tell you the problem with government borrowing is that it pushes up interest rates. And high interest rates make it difficult for businesses to make profits. They say it crowds out the private sector by pushing up interest rates. But that classical economic theory is no longer appropriate for the economic environment we are in today. Our economic environment changed radically about 5 decades ago when dollars stopped being backed by gold. Up until 1968, there was a law that required the Fed to hold gold for every dollar that it issued. And so this limited how much money the Fed could create. And importantly, under this system where gold was money, had other important implications. The most important of which, perhaps, is that when gold was money, that meant that trade between nations had to balance. Because, for instance, in the year 1900, if England had a very big trade deficit with France, England wouldn't have to put its gold on a ship and ship it over to France to pay for its trade deficit. And that would have caused the money supply in England to contract very sharply. And that would have caused them to have a severe economic recession. And unemployment would have gone up, and they would have had deflation. The opposite would have happened in France. They would have had more gold, so credit could have expanded more. Their economy would have boomed. They would have had full employment, and they would have had inflation. And pretty soon, the rich French would start buying more cheap English goods, and the poor unemployed English would stop buying so many expensive French goods, and trade would come back into balance again. So there was an automatic adjustment mechanism under the gold standard and under the Bretton Woods system, which followed the gold standard, that ensured that trade between nations had to balance. Now, the point I'm getting to is that when we stopped backing dollars with gold around 1970, it was no longer necessary for the United States to pay for its trade deficit with gold. It could just pay for its trade deficit with paper dollars, of which there was no limit as to how many could be created, or more precisely with treasury bonds, which similarly, there was no limit as to how many treasury bonds the government could create and pay for its trade deficit. So by the mid-1980s, the US was running an extraordinarily large trade deficit, roughly 3.5% of GDP. That was unprecedented. But by 2006, this trade deficit had blown out to 6% of GDP. That was $800 billion in 1 year. Now, the significance of this was when we stopped backing dollars with gold, the United States could buy things from other countries. And we started buying more and more things from countries with very low wages. And this was extremely deflationary. So as we bought more goods from low-wage countries, that put downward pressure on US goods and inflation. And the inflation rate fell and fell and fell. And we saw inflation peak about 15% in 1981. And in more recent years, in the years just before COVID started, very frequently the inflation rate was below the Fed's 2% inflation target and sometimes negative. So because inflation was so low, this changed the environment, our economic environment, and it enabled the government to get away with borrowing on a $1 trillion scale, borrowing and spending to stimulate the economy. And the Fed was also able to create trillions of dollars, which of course it couldn't have done if it had to hold gold to back trillions of dollars because it doesn't own trillions of dollars worth of gold. But it created a new environment that enabled massive government spending on the one hand and massive money creation on the other hand to stimulate the economy and to create wealth, all of that without leading to high rates of inflation. The inflation rate was very low. And so this created a completely new economic environment. And everyone was very confused, especially after the crisis of 2008. At that time, the government, as I mentioned, had $1 trillion budget deficits. And in 1 year alone, 2009, the money supply grew by 110%. The money supply represents how much money the Fed creates. It more than doubled in that 1 year. But there was no inflation, or I should say the inflation rate peaked at 3.8% in 2011. And by early 2015, it was negative again. And people just could not understand how we could have so much money creation and government spending without having high rates of inflation. But the answer to that question is the reason we could is because we also had globalization. And globalization was extremely deflationary because there are hundreds of millions of people in the world willing to work for less than $10 a day. And that changed everything. And that's why classical economic theory, which assumes it's built on the premise that gold is money, classical economic theory can't explain the economic environment we've been operating in, particularly over the last 2 to 3 decades, because gold is no longer money and things work differently now. Now the Fed is free to create as much money as it pleases. That's enabled the government to spend much more money than ever before. And by buying things from other countries where wages are very low, this has enabled us to avoid having high rates of inflation, at least up until 2 years ago when COVID struck. That's caused very big problems for this new economic environment I've just described, because COVID has resulted in global supply chain bottlenecks. It has been a real blow to globalization. This environment I've described only works if globalization persists, and COVID has partially been a very big setback for globalization, at least temporarily. Now, how long will this continue? Well, how long is COVID going to continue? Now, when COVID first began, I had hoped that it would end very quickly. I'm sure everyone hoped that. But we've seen wave after wave of COVID. And the last time we spoke was, I believe, in August last year. And at that point, it looked like a reasonable assumption that the global supply chain bottlenecks were going to be resolved before too much longer. The inflation rate had been quite high in the second quarter of last year, but it was considerably lower in the third quarter of last year. But then we got the Delta wave coming in just after we spoke, or about the same time. And Delta hit Asia particularly hard. I live in Asia, and up until Delta, most of Asia had not been very severely impacted by COVID. But Delta hit Asia and started shutting down the factories in places like Thailand, Malaysia, Indonesia, even China, where there's a zero COVID policy. And now Asia is being affected by Omicron. Thank heavens it's not as deadly as Delta, but it's spread so rapidly. Hong Kong, like China, had a zero COVID policy, and they were very effective. They had almost no cases of COVID until Omicron hit. Now, out of the 7 million people who live there, over the last 2 months, they said probably half the people there have had Omicron. And how do you keep it out of China if half the people in Hong Kong have it? So just this week, Shanghai is being put into lockdown. And so that's going to cause even more global supply chain bottlenecks, or at least it's going to continue to cause problems at the global supply chain level, problems for globalization. And hopefully this will be the last wave of COVID, but we don't know. There could be more. And COVID could spread all over China. If so, the Chinese policymakers could actually shut down 50 cities, all with 5 million people or more, and thousands of manufacturing facilities. So we could still experience worse than we've experienced thus far in the global supply chain bottlenecks because of that. And as if that were not enough, now Russia has invaded Ukraine. And that's created an entirely different set of global supply chain troubles because, of course, Russia is a very big oil producer. So oil prices have shot up, wheat prices have shot up again, metal prices have shot up. So just as the commodity prices were beginning to fall, the Bloomberg Commodity Index peaked at about 50% up year on year toward the end of last year. And by just before the invasion of Ukraine, it was coming down pretty rapidly. It was up 25% year on year. But now it's back up to be 50% up on year again. And we don't know what's going to happen. Hopefully this invasion will end soon and have a very happy ending and life in Europe will go back to normal. But it may not. Of course, it could even get worse and spread to other countries. We just don't know what's going to happen. So there's a severe blow, a double blow now to globalization. First COVID and then the invasion of Ukraine, disrupting this whole really Goldilocks environment that we've lived in for such a long time, where the governments could get away with trillion-dollar budget deficits and the Fed could create trillions of dollars to finance those budget deficits at very low interest rates with very low levels of inflation as well. But now inflation's here. So this is going to cause us a lot of problems in the near term.
I mean, it's been a long time since we've seen inflation, especially to this degree. What's been interesting is we've had such a low inflation environment for such a long time that a lot of people, they just take it as truth, as this is the way things are. Now that things are changing and, we're having much higher rates of inflation, even though interest rates are still low, we've seen this in the 70s. So where do you see this going? Do you see this becoming the stagflationary 70s, or do you see this turning out in a different way?
Honestly, it's very difficult to make any projections. I don't know if there are going to be more waves of COVID, and I don't know if this war in Europe is going to spread or end tomorrow. There are apparently peace talks going on at the moment that seem to be promising. If a peaceful resolution is reached, then commodity prices will drop very sharply. Oil will plunge, wheat will plunge, of course, if the sanctions are lifted, but it's uncertain whether that's going to happen. I would like to think that a best case scenario, which I think is reason to be optimistic that that's a possible scenario, let's say Russia withdraws, most of the sanctions are lifted, so commodity prices come back down again rapidly. Then we'll be back dealing just with the COVID issues. If Omicron is the last wave of COVID and it sort of gradually disappears, or at least doesn't continue to disrupt the economy, then with a little time, the global supply chain bottlenecks will be worked out. There will be more semiconductor factories, therefore more cars, and therefore used car prices will fall. Therefore, the inflationary pressures will go away. Now, for inflation to last, it's not enough for oil prices to shoot up one year by 50%. They have to keep shooting up year after year after year. And that just normally doesn't happen under normal circumstances. So they've shot up a lot already, but it's unlikely that that this inflationary pressure will last. And it's likely that globalization will regain its footing and will be back to where we were before COVID started, with hundreds of millions of people around the world willing to work for very low wages, putting downward pressure on US wages and the cost of manufactured goods. And we'll be back in a low inflationary environment again. Also, the recession that's probably looming ahead of us will destroy demand in the US and everywhere in the world, and that will put more downward pressure on inflation. So I think eventually, hopefully sooner rather than later, the inflation will go away and we'll be back into a very low inflation regime again, under the assumption that there's no war and under the assumption that COVID goes away. So that's the best case scenario. In that scenario, then there's no problem with government continuing to borrow. And there's no problem with the Fed continuing to create a lot of money to help the government borrow at low interest rates. Right now, taking the gross government debt as a percent of GDP, the US government debt to GDP is the ratio of US government debt to the size of the US economy is 130%. In Japan, the level of Japanese government debt to the size of Japan's economy is twice as large as that. Japan was where we are now more than 20 years ago in terms of their debt to GDP. There's no reason to believe the US government couldn't continue to borrow on a large scale, assuming globalization recovers, putting downward pressure on inflation again and taking us back to where we were pre-COVID. So that's the best case scenario, return to where we were pre-COVID. There are a lot of much worse scenarios than that. You can go to extremes if you want to talk about very, very bad case scenarios. Say a moderately bad scenario would be where there are more waves of COVID and the war doesn't end and the inflation rate stays at current high levels. Most recent number was 7.9% for February, CPI inflation. If inflation stays at these high levels, another 24 months, for instance, the Fed would have to increase interest rates very sharply, and they would have to do a lot of quantitative tightening, destroying money and sucking liquidity out of the financial markets. In that scenario, then it's very likely that stock prices would fall a great deal, property prices would fall a great deal. For instance, the Fed has been creating money and buying government bonds, but also mortgage-backed securities, which has pushed up the price of the mortgage-backed securities, and that's pushed down mortgage rates. But now they're going to start doing the opposite of that. In effect, they're going to start selling not only government bonds, but they're going to start selling the mortgage-backed securities that they've owned, that they bought during quantitative easing. And as they sell those mortgage-backed securities, that's going to cause their price to fall, and that's going to cause mortgage rates to go up. And as mortgage rates go up, of course, the property market's going to stop. Property prices are going to stop rising and start falling, depending on how high they go. So not only would asset prices fall, stock prices, property prices, and all the most speculative asset classes, but the economy would also go into what could be potentially quite a severe recession. And unemployment would go up, people would lose their jobs, and wages, instead of going up, they would go down. And that sort of severe recession would reduce demand and eventually cause the inflationary pressures to go away. That would be a moderately bad scenario.
I mean, obviously, well, I shouldn't say obviously, but I would think that the Fed is not oblivious to this dilemma they find themselves in. So looking at this choice of either we let inflation take off by keeping low interest rates, or we raise interest rates and effectively force a recession at some point, what do you think is the Fed's most preferable choice? Because at some level, if they know this is going to happen, they're just trying to, I would assume, soften the outcome. Which one do you see as their preferable choice? High inflation or forcing us into a recession?
There's nothing the Fed can do to pump more oil or to manufacture more semiconductor chips. So the way that they can fight inflation is by throwing people out of work and making the unemployment rate go up and causing asset prices to fall so people will have less money to spend. All they can do is to fight inflation is to cause a recession and to cause a stock market correction. They don't want to do that. They've been under the impression, and they will admit they were wrong, they assumed that the inflation was transitory and that the global supply chain bottlenecks would get worked out last year and that the inflation rate would come back down again. But that's not been the case, as we've discussed. But they're still hoping that's what's going to happen. Of course, they've been blindsided by this war now. They're hoping this war will end. And if it does, and if the global supply chain bottlenecks are worked out, as they believe they will be, then they won't have to throw millions of Americans out of work and cause the stock market to crash. So they've been taking it very, very gradually. Many people say way too gradually in tightening monetary policy. I mean, after all, they just stopped quantitative easing in March. They were still creating money until early March. The federal funds rate was 0% until the March FOMC meeting. Now it's 25 basis points. So they could have increased it by 50 basis points, but they didn't want to spook the market. The market was already spooked at that point by the Russian invasion of Ukraine. And so they took it very gradually with a 25 basis point rate hike. And they're hoping that they can go gradually and lifting interest rates without causing a severe stock market sell-off and a severe recession and throwing millions of people out of work. They believe if they take their time and pace these interest rate hikes out slowly, then before too long, the global supply chain bottlenecks will be worked out and the inflationary pressures will go away. And they won't have to crush the economy and throw millions of Americans out of work and crash the stock market. So that's what they're hoping. Of course, they don't know, just like everyone, they don't know what's going to happen next. They didn't expect this war, and they probably expected COVID to have ended already. So they're hoping that they can walk a middle path, hike interest rates gradually, and not have to crush the stock market. Now, one big thing that is going to be very important is not just hiking interest rates, but they're about to start reversing quantitative easing. They have created almost $5 trillion since the end of 2019, which has more than doubled the size of their total assets just since the end of 2019. And this has created just a tsunami of liquidity in the United States and all around the world, which has pushed stock prices to record highs and, as I mentioned, drove household sector net worth up to $150 trillion and pushed up all kinds of crazy assets to ridiculous levels. Well, they're about to start reversing that. But even when they do, they've already created so much liquidity that this liquidity that already exists is going to continue to be around for a while until they destroy it through quantitative tightening. That's going to take some time, but there's plenty of excess liquidity right now. That will underpin the stock market and the property market until they get aggressive about destroying all of that liquidity through quantitative tightening. So their next meeting is on May 3rd and May 4th, and they're likely to tell us at that time more details, and perhaps a lot of details, about how quickly they're going to launch quantitative tightening, how large it's going to be, how many dollars they plan to destroy each month, and so on and so forth. So that's something that could spook the markets as we get closer to that date. Because if that's their plan, and it probably is, the Fed governors will start making speeches, letting it be known, dropping hints about what they intend to do. They always tell you in advance what they intend to do so that no one's too shocked when they actually do it. They'll begin taking away liquidity. And this liquidity, it's like, think of a big party in a ballroom full of people, full of air. The liquidity is like the air in the ballroom. You tell people you're going to take a little bit of air out of the ballroom and no one panics. But when you get to the point when you've taken a lot of air out of the ballroom and people start to have problems breathing, then they panic and you get big corrections in the stock market. Last time they did quantitative tightening, they started at the end of 2017, and it took about a year before we started seeing significant volatility, big volatility in the stock market. But the fourth quarter of 2018, there was a big correction in the stock market. There was another correction in May 2019. And so at that point, the Fed then stopped tightening and they stopped quantitative tightening and they stopped hiking interest rates. And before long, the liquidity crisis occurred in the repo market in September of 2019. They did a monetary policy U-turn and they started cutting interest rates, and they even relaunched quantitative easing just 1 or 2 months after they had stopped quantitative tightening. So it takes some time for quantitative tightening to suck the liquidity out of the markets. In other words, to suck the air out of the ballroom. It may not cause an immediate stock market crash when they announce this, but gradually it's going to create a much more difficult environment for the financial markets. And if they have to continue tightening monetary policy because the inflation rate stays high, then it's going to become very hard to breathe for investors in the ballroom. And they will be forced to sell their assets, and asset prices would fall under that scenario.
Let me ask you a few other questions here. I know we're kind of getting close to time, but people have just started to talk about stagflation, which been many years since we've experienced it. Given the environment that we're in, which is a very challenging environment, what you're talking about, and I totally agree, you get to this point where they're forcing the economy into a recession or whether they want to or not, they may be forced to have that happen. What's the best way to invest in this environment? I know a lot of people have 60-40 portfolios, and there's an assumption that when stock prices go down, interest rates go down, and thus the prices go up. So they offset each other. And that's been in favor since the 80s. And, we've had the biggest bond bull market, at least in modern history. I don't remember about how far back that could go, but certainly it's been over 40 years of bond bull market. So what are some good ways to invest? I mean, if interest rates are going up, then bonds aren't necessarily safe. But how would you look at that as a way to kind of people can protect themselves?
Just one more word on the last subject before how to invest. We've been focused on the negative aspects of the high level of inflation. We should also draw attention to the fact that because of the government's very aggressive policy response to COVID, increase in the government debt of $7 trillion and the $5 trillion of money creation by the Fed, that had extraordinarily positive impact on the economy. The unemployment rate peaked at 14.8%. Now it's 3.8%. The GDP grew by 5.7% last year in real terms. That was the highest since 1984. So it could have been a completely different story. If they had not come through with this stimulus, we could still have double-digit inflation and we could still be in a severe recession. And we wouldn't have to worry about inflation then, but people would have to worry about, since they wouldn't have jobs, so many of them, they'd have to worry about where their next meal came from. So the inflation level that we have now is uncomfortable, but at least everyone who wants a job has one, and people aren't going hungry, and the economy is strong at the moment anyway. So I just wanted to get that out there. Inflation rate is, it's a multi-decade high, but so was GDP growth last year. I think if I had to make a choice of full employment versus 7.9% inflation, I think the Fed and the government made the best choice they could given the information they had at the time, and they would probably do it again. Now, how to invest? Well, for normal people who are not super sophisticated hedge fund managers, who, by the way, don't always do so well themselves, they're not really any good investment opportunities that stick their heads up. Now, some people, if you are brave and really tuned into how the markets work, you can short the markets, expecting them to fall. That's dangerous. It's very dangerous. Unexpected things happen and shorts get crushed. So, we've been through a very long period where wealth has grown and grown and grown, largely due to what the government has been doing to manage the economy with extremely low interest rates and quantitative easing and lots of fiscal stimulus. Wealth has doubled since 2007. I would expect it's going to be difficult for people to retain the wealth they have currently. They should expect some of their gains of the last 15 years to be destroyed. That's probably what's going to befall most people, certainly in the moderately pessimistic scenario I laid out above, where the inflation persists.
In your book, you certainly laid out the history, you laid out some of the problems, but you also laid out some of the solutions for how we can get out of this situation, which definitely seems precarious. So what are some of the things that we can do to improve our economic situation in this country?
So, Kirk, this book has had pretty unfortunate timing. It took 4 years to write this book. I wrote it it was 2018, 2019. It was more or less finished by the time COVID started. And then I had to put the book on hold because it was very uncertain how much the government debt would increase by, how much money the Fed would create. And I had to rewrite several chapters during 2020. And then there seemed to be more clarity. So I moved forward with having it published. The production process takes about 6 months to produce these books. It covers up to about the middle of 2021. But when I wrote this book, I was looking at the global environment where globalization was the dominant factor in terms of inflation. Now, inflation is caused by, in the old days, it used to be caused by money supply growth, but it's also caused by supply shocks and demand shocks. And there can be inflationary supply shocks and deflationary supply shocks. Well, globalization has been an extreme deflationary supply shock, pushing down inflation for the last 3 or 4 decades. The first 2 parts of the book are history. The third part of the book draws on lessons from that history about how we can implement better policies that will make the future better. The first part of the book is a history of the Federal Reserve and the history of money since the Fed was created in 1914. And the second part is the history of credit and this growth of creditism, as I call it, as our economy became addicted to credit growth. And the environment I was looking at then was one where after 2008, as we've already discussed, the government responded with trillion-dollar budget deficits. The Fed responded by creating trillions of dollars to finance those budget deficits. That still didn't cause inflation. So that was the context in which this book was written. And I thought, okay, if we can get away with the government having trillion-dollar budget deficits and the Fed financing those budget deficits with with money creation without causing inflation, then this creates a once-in-history opportunity for us, for the government to borrow on a very aggressive scale and invest in new industries and technologies, and for the Fed to finance that government borrowing through paper money creation, as it did following the crisis of 2008. So the book, in part 3, advocates that the government fund a multi-trillion-dollar investment program over the next 10 years, targeting the industries of the future, things like artificial intelligence, quantum computing, neural sciences, genetic engineering, biotech, nanotech, robotics, and green energy. And it shows how easy it would be for the US government to finance investment on this scale. Now, the government could do this the way that it did NASA, under one big roof, or more palatably for most people, the government could do this following a venture capital model, where the government raises the money and then sets up joint venture companies with the private sector, say the 10,000 most promising entrepreneurs in the United States, entrepreneurs and scientists. The government borrows the money and funds these joint venture companies lavishly, keeping a 60% equity stake. And the entrepreneurs and scientists manage these companies, and they keep a 40% equity stake. An investment on this scale would be certain to induce a technological revolution that would turbocharge US economic growth and result in extraordinary technological breakthroughs, as I show in great detail in the third part of the book. $1 trillion is an enormous amount of money. Now, you can see why the outbreak of COVID has caused me headaches. In the book, I don't put a price tag on exactly how much the government should invest. Instead, I advocate that it invest as much as possible, as soon as possible. If that causes the economy to overheat and leads to higher rates of inflation, then they can back off for a while until the inflationary bottlenecks that are causing the inflation are overcome, as they eventually always are. I use an example of the government could fund a $10 trillion investment program over the next 10 years. That was the example I used in the book before COVID started. 10 trillion over 10 years. Well, because of COVID, government debt has gone up $7 trillion over just 2 years. And the Fed has created $5 trillion over just 2 years. So what I was describing in the book, on one level, this validates the point I'm making in the book about how easy it would be for the US government to fund a multi-trillion-dollar investment program targeting the industries of the future. And many people think that, okay, even if this is a good idea, it's never going to happen. The government would never do anything like that. Kirk, since we last spoke, there's actually been enormous progress in this direction. Last year, in February, the House of Representatives passed the America Competes Act, which allocates $350 billion for investment in new industries and technologies, and allocates specifically $52 billion for investment in semiconductor manufacturing facilities to be built in the United States. And last year, the Senate in July passed a similar act called the United States Innovation and Competition Act, which allocates $250 billion for investment in new industries and technologies, the same ones that I mentioned earlier in our discussion, and also includes $52 billion from semiconductor manufacturing. What I advocate in the book has actually begun to be implemented. It's not on a multi-trillion-dollar scale, but hey, $250 to $350 billion is an important step in the right direction, a first step in the right direction. So the book shows how easily this could be done. In other words, the book is called The Money Revolution, because a money revolution has occurred in the United States, and in fact, around the world. Once money ceased to be backed by gold, credit exploded, and opened up globalization, pulling hundreds of millions of people out of poverty, keeping a lid on inflation, and created a new economic environment that really presents us with a once-in-history opportunity to invest on an extraordinarily aggressive scale in new industries and technologies. And if we do that, we truly have the potential of magnificent accomplishments. We could potentially cure all the diseases and extend life expectancy by perhaps decades, clean up the environment, and very importantly, ensure US national security. Because at the moment, we're about to be overtaken by China technologically, economically, and militarily. There's a reason China has hypersonic missiles and 5G, and the United States doesn't. It's because the Chinese government and China as a whole invest much more in research and development now, these days, these recent years, than the United States does. And if China continues to increase their investment at the current rate, and we continue to increase our inadequate investment in R&D at the current rate, by the end of this decade, China will be investing 40% more than the US every year. And that means that China will achieve artificial intelligence before the United States does. And at that point, there'll be no stopping them. Whoever reaches artificial intelligence first wins. That is the 21st century equivalent of having a nuclear weapons monopoly. That's another reason the US must invest. In fact, that is the reason that both the Senate and the House of Representatives passed these two laws, these two acts that I just mentioned, for fear that we're about to be overtaken by China. So that's what the book is about. A money revolution has occurred. It opens up extraordinary opportunities for the government to invest on a very aggressive scale without creating high rates of inflation, I thought, before COVID and before the Russia invasion of Ukraine. Now, if we, in the optimistic scenario, where we move back to globalization recovers, global supply chain bottlenecks go away, the Russians withdraw from the Ukraine, then it's very possible that a few years from now, we'll be back, as I mentioned earlier, back in a position where the inflation rate is once again very low, as it was before 2019, before 2020. And at that point, then we should grasp this opportunity to start investing very, very aggressively in new industries and technologies. There are so many reasons for us to do that.
Well, Richard, I really appreciate you coming on the show once again. I know, obviously, there's a lot going on in the global economy, and I always appreciate your insights. So where can people find more about you and your new book?
People can find out more about me at my website, richardduncaneconomics.com. There's a link there to buy the book, or they should be able to buy the book in fine bookstores anywhere they still exist, and of course on Amazon. If I may, I'd like to also mention to your listeners my video newsletter, Macro Watch. It's a video newsletter. Every couple of weeks, I publish a new video of me making a PowerPoint presentation discussing something important happening in the global economy. The last one was called Fear the Fed. It came out before their FOMC meeting in March, discussing many of the things we talked about tonight. If your listeners are interested in subscribing to Macro Watch, they should click the subscribe button, and I'd like to offer them a 50% subscription discount. They'll be prompted to put in a coupon code. If they put in the coupon code TREE, T-R-E-E, they can subscribe at a 50% discount. I hope they'll visit my website, richardduncaneconomics.com, and check out Macro Watch, and please buy my book.
So now we're getting into the panel portion of the show, where we have our very own Megan Gorman. Hey, Megan.
Hey, Kirk. How you doing today?
Doing great. And also we have our very own Barb Friedberg. Hey, Barb.
Good morning. Happy to be here.
Good. Well, glad to have you both. So let's just dive right in. Megan, what were some of your takeaways from the interview?
It's always interesting to get the backstory on it and the history of it, because I think most people don't fully understand how inflation happens. So I think that to take an interview like this and give it context, the question is, what are you doing in your investment portfolio that would allow you to battle inflation? And the other thing is, how do you plan for inflation over your lifetime? So two very, very distinct themes that I think that come out of this interview.
Barb, what about you? What are your thoughts?
The other thing that listeners and everyone needs to think about if you're an investor is the reality that markets are not always stable. They don't always go up. And we've seen that during the last couple of months, that we've had a correction really that we haven't seen in a couple of years. And over the past 10, 12 years, markets have gone literally up with minimal breaks. And so how do you prepare yourself both psychologically and practically with your investments to handle what promises to be a little more volatility on the downside than we've seen in the future?
It's important to really not only point out the issues, but also to talk about how to handle them, right? Because knowing about them is one thing, but all it does is stress you out if you don't know how to handle them. So let's start there, Barb. How would you, as a former portfolio manager, how would you think about managing a portfolio when you have, inflation at 8% plus?
We always start from, when crafting a portfolio, of what is your risk tolerance and what are your financial goals? Those are the two main questions that we ask ourselves. So if you're going to need money 5, 10, 15, 20, what do you do? And how much risk can you handle? And that question relates to how much can you tolerate variations on the downside of your portfolio, because none of us have trouble handling the up movements of our investments. And then to add in inflation, which is a reality now. Hey, have you been to the store, right? Inflation is rampant. We don't know if it'll stop. We don't know if it will abate at some point and at what levels. So we've got a lot of unknowns in our society now that are going to affect both our pocketbooks and our portfolios. So how do you invest? The rule of thumb really holds. So if you can't handle market volatility, if you are going to run when your portfolio drops 5, 10, 15, 20%, then you need to dial back your equities. Okay, you just need to dial it back. A lot of investors, particularly newer investors that have just gotten into the market, are at like a 90 to 95% equity versus fixed makeup in their portfolio. And that means, stocks versus bonds. And when stocks are going up, well, that's awesome. But what about when they start to go down and you've got a $50,000 portfolio that's worth $30,000 or a $500,000 portfolio that's then in a year worth $300,000? You need to think in a global sense of, maybe I should adjust my asset allocation. And if you're a little too aggressive, maybe sell off those stock assets and divert your money into either cash or very short-term bond funds. And I say cash because interest rates are going up now. There is no doubt that this year interest rates are going to go up. The Fed has told us. So if you have some cash, you can start slowly deploying it into fixed assets at higher interest rates. And that will create a cushion for your stock market investment. So when they fall a little bit, you've got some bonds that are going to increase your returns. And I want to caution you, don't try and jump in and out of the markets. You could say, well, gosh, if things are going to go really badly, I'll just sell all my stocks and then I'll relax and get back in when the stock market starts to reverse and go back up. Sounds like a plan, right? The problem with that plan is, how do you know where the bottom is? And how do you know when is the right time to get back up? Markets move in very rapidly in small periods of time. So there have been studies that have said that if you miss the best days of market performance over a 5, 10, 15-year period, and I'm talking best days of 15, 20, 40 days, then you're going to miss all of the upward movement. So you can't time the market successfully. So takeaway, keep a portfolio that is in line with the level of risk that you can handle, and be prepared for potential drops in the portfolio. Don't have money that you need in the next few years in the stock market, because then when you need to pull it out, it might be worth less. History has shown us that if you just stay invested over time, returns typically are quite satisfactory.
And Megan, what about you? With inflation rearing its ugly head now, you certainly have to take this into account with portfolios for your clients. So how do you think about things differently when you're managing your clients' assets in inflationary times?
Well, the first thing is you don't just start thinking about it now. This is something you always have to be factoring in. When I'm constructing people's financial plans, we've always, when we've done long-term planning, assumed an average inflation rate of about 3.5%. For the past 20 years, up until about 2021, inflation was about 2%. So I always looked like I was being incredibly aggressive with clients on inflation, but over time, it will likely even out. So running your long-term numbers at a higher inflationary amount is something that you should always be doing. And what concerns me for a lot of people who are retired today is that a lot of retirement planning has been done at a very low, if at all, inflation rate. I will tell you, I do get to see things that other people's put together, and I'm often shocked at some of the assumptions factored in. So I think when you're building a long-term plan, that's the first thing. The second thing is, touching on what Barb brought up, you really need to know your asset allocation and what you're comfortable with. In these types of markets, I don't have clients that are trying to figure out what their risk tolerance is at this point. They know it, and it's about sticking to strategy. So if they're 60% equity, 40% fixed income, or 10% alts, 50% equities, 40% fixed income, they already know that. But what it's key is to think about what elements in your portfolio perform well in an inflationary environment. And most of us have what we need in our portfolio, which is we have stocks or equities. They are the best hedge against inflation. But people want to feel that they're doing things or that they have other segments of their portfolio that work. And that's why it's really important to think about the fact that within certain asset classes, you can have slight tilts. So for instance, inside our bond portfolios for years, we've had a floating rate fund. Floating rate fund is where banks make loans to corporations, but they're at variable rates. And so they do really, really well in high inflationary markets. I've often used an opportunistic bond fund that has always had a little sliver to tips. Again, a type of bond that does well in high inflationary. So you want to be thinking about, as you construct a portfolio, the relationship between stocks and bonds, and your stocks are the inflation hedge. But as you dive into each area, what are the little pockets that you can build that can help in challenging marketplaces? And those are some of the areas that we typically see.
A lot of people look at their portfolios in kind of a binary way. You invest in stocks and bonds when one goes up and the other goes down. Then that mostly holds true. It doesn't always hold true. And now is actually one of those times where it may not be holding true completely. For example, if you look at interest rates are going up, which means that the value of those bonds are going down. And that's been happening this year quite a bit, actually. A lot bigger degree than probably most people would have expected. And yet equities are down. So those people who are in a 60-40 portfolio who thought that they'd be safe, it holds true most of the time, but not all of the time. So if nothing else, you should just be aware of the impact of this changing environment that it's having on you. And that is one prime example. Another example, and actually something Barb mentioned earlier, which I thought was funny, that when you talk about things like volatility, people don't worry about volatility when it goes up. They only worry when it causes the markets to go down. But in reality, the volatility is picking up, and that is going to cause more ups and downs in the market. I keep raising this point over and over, and I feel like I need to, because it's conceptually, you can understand it, but in reality, it's not immediately apparent, which is the value of cash, especially in times where inflation is 8%. And some people would argue higher, but I'm not going to make that argument. Let's just say it's higher than normal. than what we've experienced. And when you have high inflationary times, people are worried that their cash is getting inflated away. And in some senses, that's true. However, if your asset prices go down, that's a similar effect. Cash actually is a strategic position in certain times. And if you're worried about markets being overvalued or inflation causing havoc with your portfolio, don't be afraid to have extra cash, and don't be afraid of inflation eating away at it. Now, if we have inflation in the 8% range plus for the next 10 years, yeah, that'll be a problem eventually. But in the short term, is it a problem? Probably not. Having cash, so if the market drops 20%, having cash is actually a good idea, right? Now, we don't know what the market's going to do. I'm just giving a scenario here. So think about cash strategically, and don't be afraid to hold some, even if we have inflation. Because when we have high inflation, one of the challenges of the market is it tends to ding a lot of different asset classes. Commodities tend to do well, but things like equities don't always do well, or certain equities will, but not all equities. And bonds also can be dinged around quite a bit with higher interest rates. So I think you just have to keep in mind that sometimes there are very few places to hide when the storm's coming, and sometimes cash is that place. I'm not saying put your whole portfolio in cash, but don't be afraid to have extra, because in the last few years, I started to see a lot of 80-20, 90-10 portfolios where people who were generally relatively moderate risk tolerance, some even conservative, were in a 90-10 portfolio. And I just shake my head. And I understand why people are doing it, but you have to understand that the markets don't go straight up. And we do have periods of excess, which we've had, and then we have periods where it rebalances and things tend to dip a little bit further than people expect. So as Megan and Barb had said, is just understand what your tolerance is for risk and make sure you're reassessing your portfolio so that it's balanced in line with that. And the best way to do that is to look at different scenarios. What is the portfolio going to do if the market drops 20%, or if it drops 30%, or if interest rates go up another 2 or 3%? Deep water test your portfolio for that and see if you're comfortable with the outcome. And if you're not, then you need to make changes. Now is the time to make these changes and to figure out where your comfort levels are, because if things do get worse, then you have the time to be prepared. And now is the time to be prepared. And if things get better, great. You'll probably feel like you're missing out, but at the same time, risk management is the one thing that you can plan for. You can't plan for performance, but you can manage risk. I do want to get into one more question before we wrap it up here. We want to talk about being ready for bad times, or being ready for the pain, or stress testing your portfolio. You know, Barb, I know you've done a lot of this throughout your career. How would you go about doing that for people with their portfolios?
Kirk, you just mentioned it. You just actually went through the exact steps that I do to stress test a portfolio. I get my Excel out and I look at my percentages of stocks. And then I multiply that by a decline of 30%. Then I look at my bonds and I assume, okay, so let's just say they drop 2%. And then I look at my cash and I add all those figures up and I go, okay, this I think is probably the kind of worst case scenario. It's not absolute. Look, things could get really bad, but that's a likely worst case scenario. And then I go, okay, so my portfolio on aggregate, based on the asset allocation that I have or the percentages in each asset class, my portfolio during what I perceive as the worst case scenario is going to drop 20%. So how am I going to feel about that? And am I willing to wait it out? Now, some people out there say, you know, you've got to avoid losses at all costs. And as I mentioned in my prior comments, I don't ascribe to that, because market timing, trying to avoid all losses, is really a fool's errand. It just doesn't work. And that is why we say investing is for the long term. So stress test your portfolio by plugging in some worst case scenario assumptions. And if your portfolio comes out at worst case scenario, it's going to drop 60% or 50% or 40% because it's all stocks or, whatever, then make your adjustments. Sell some of the equities now. But whatever you do, what the behavioral economics, the behavioral finance of investing has shown that many, many, many people panic when markets drop and they sell at the bottom. Don't do that. Expect markets will be volatile because that's their nature. Be prepared to hang in there for a while because over time, markets have rebounded. Sometimes it takes a while. So again, another piece of advice, if you need money within 5 years that is now in the stock market, get it out of the stock market because some rebounds take a little longer. Investing is really for long-term goals. It's not for, the vacation you want to take next year or the home down payment you need in 2 years. If that's the money you're saving for, it should be in cash or very short-term bond funds. And Kirk, before I shut up, let me just say, we've talked about bonds. You raised some really good points about how stock bond portfolios are or could perform. And for investors who are in bonds, and I personally like them, even though longer-term bonds are going to decline as interest rates go up, I suggest keeping your fixed assets in shorter term bonds and bond funds, or as Megan mentioned, floating rate bond funds or individual floating rate bonds. Because what that means is they're likely to fall less than longer term bonds when interest rates rise, which they will do. And the great thing about rising interest rates is that when interest rates rise, your new investments, either in the bond fund or in individual bonds, if you're purchasing those, are going to have higher coupon rates and higher yields.
So as we kind of get close to wrapping it up here, Megan, final thoughts from you.
When you run long-term scenarios with your planner, your advisor, always ask them what inflation factor they've used. And don't be afraid to ask them to run at higher rates to see where your vulnerabilities are. And then always remember in your portfolio, you already have a lot of hedges against inflation. But ask your advisor to point out what are those things in your portfolio that are working well for you in this market environment. So I'm Megan Gorman. You can find me at Forbes.com/Megan Gorman. Kirk, thanks for having me on. Barb, great seeing you.
Thanks for coming on, Megan. And Barb, final thoughts from you.
Gave my final thoughts. I am Barbara Friedberg. You can find me at Robo Advisor Pros, Barbara Friedberg Personal Finance, and on my YouTube channel. Great to see you guys, and I'll be around next time.
Thank you both for coming on. And that's the show for this week. Thank you again for joining us in Money Tree Investing Podcast. My name is Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on the show. Please remember to subscribe to the podcast on the podcast app if you're choosing. You can also check out the show at moneytreepodcast.com. On our website, you'll have access to all our show notes, resources, and the archive shows. Also, we're now on YouTube, so please check out our YouTube channel. When you're there, please subscribe and leave a comment. Lastly, please leave a show rating and comment in the podcast app of your choice. Have a great week ahead. And remember, no one will care about your money like you do. So invest in your life.
Thank you for listening to the Money Tree Investing Podcast. Visit us at moneytreepodcast.com for more free investing resources.